I want to talk to you tonight about something that happened in Beijing that is more consequential for your daily life than any missile that has been fired, any facility that has been struck, or any military action that has dominated the news cycle over the past several weeks. I want to talk to you about $45 billion, not $45 billion in military hardware, not $45 billion in humanitarian aid, $45 billion in U.S. Treasury bonds that the People's Republic of China, through its sovereign wealth management instruments, has formally suspended from trading. What is being described in the financial press as a freeze, but which those with experience in monetary statecraft recognize as something more precise and more deliberate than that word implies. A freeze suggests a temporary hold, a reaction, something that might be reversed. What China did this week is not a freeze in that sense. It is a demonstration. China holds approximately $761 billion in U.S. Treasury securities as of the most recent Treasury International Capital data from February 2026. Of that total, $45 billion has been placed in a category of restricted disposition, meaning China is signaling that it retains the option to sell, to hold, or to use as diplomatic leverage at a moment of its choosing. It is not moving the bonds. It is demonstrating that it can, and the demonstration, not the bonds themselves, is the weapon. I need you to understand something before we go further. The United States national debt is currently approximately $36 trillion. The interest payments on that debt depend on a functioning treasury market, a market where buyers and sellers transact at rates that make continued U.S. borrowing sustainable. China is the second largest foreign holder of U.S. debt. When China signals to that market that $45 billion in holdings are in a category of restricted disposition, it is not threatening the treasury market directly. It is reminding everyone who participates in that market that China has the option to threaten it. The reminder itself changes calculations. The reminder itself has value. And the timing of this reminder, coordinated as I will show you with specific escalation events in the Middle East, is not coincidental. In the next 20 minutes, I am going to walk you through exactly what China did and why the financial press is understating its significance, what the relationship is between this action and the military escalation in the Middle East, what $45 billion represents in the context of China's broader strategy for reducing dollar dependence, and what this means for anyone who holds a mortgage, has a retirement account, pays a heating bill, or relies on freight transportation. This is not an abstract financial story. This is a story about economic leverage being deployed as a geopolitical weapon, and it is being deployed right now. Subscribe now, if you have not already, because the analysis you are going to get from standard financial media on this event will significantly understate what is happening. Let us start with the mechanics of what China actually did, because the precision of the mechanism reveals the precision of the intention. U.S. Treasury securities are the financial instrument through which the United States government borrows money. When the U.S. government needs to fund its operations and its debt service, it issues Treasury bonds, notes, and bills. Investors around the world, governments, central banks, pension funds, sovereign wealth funds, purchase these instruments because they are considered the safest financial asset on earth. The global demand for U.S. treasuries is what allows the United States to borrow at relatively low interest rates. It is what makes the dollar the world's reserve currency. It is the financial architecture that underwrites American geopolitical power as surely as aircraft carriers and nuclear weapons do. China's $761 billion in treasury holdings are managed through the State Administration of Foreign Exchange and through subsidiary sovereign instruments. The $45 billion that has been placed in restricted disposition was not selected randomly. According to analysis by the Bank for International Settlements and confirmed by conversations between European Central Bank officials and Bloomberg's finance team, the $45 billion corresponds specifically to Treasury bonds with maturities falling within the next 18 months, bonds that would normally be rolled over in routine Treasury auctions. By placing these specific bonds in restricted disposition, China is signaling that it may not participate in the rollover auctions for those specific maturities. This matters because Treasury rollover auctions require sufficient demand from existing holders. If China announces at a moment of its choosing that it will not participate in a specific rollover auction, the Treasury must find alternative buyers at whatever rate the market demands. If the market is uncertain, as it tends to be during periods of geopolitical escalation, it demands higher rates. Higher rates on Treasury bonds mean higher rates on everything connected to government borrowing, including, eventually, your mortgage, your car loan, and the credit lines that small businesses use to make payroll. China has not pulled the trigger. China has put its finger on the trigger in full view of every participant in the global financial system and said, I want you to know the trigger is here. Announcement number 1. The $45 billion freeze is not a financial action primarily. It is a communication. And the message is directed not at Wall Street but at Washington. and specifically at the decision makers who have been managing the U.S. posture in the Middle East without adequately accounting for China's capacity to impose economic costs. Let me explain the timing because it is the timing that confirms the intentionality. The restricted disposition announcement came 3 days after U.S. forces in the Red Sea conducted what CENTCOM described as kinetic interdiction operations against Houthi, Ansar Allah, maritime denial assets. Those operations, which involve strikes on positions that Chinese shipping companies use as reference points for their Red Sea corridor risk assessments, directly affected Chinese commercial interests. Two Chinese-flagged vessels that had been transiting the Red Sea under a de facto safe passage arrangement, an arrangement that Chinese officials had quietly negotiated through Omani intermediaries, were forced to divert following the U.S. strikes on the positions that served as safe passage reference points. China's foreign ministry issued a statement expressing strong concern about threats to shipping. 3 days later, $45 billion in Treasury bonds entered restricted disposition. The sequence is not ambiguous. According to Dr. Michael Pettis at Peking University, who has written extensively on China's monetary statecraft, this sequence follows a pattern China has used in economic coercive contexts at least 7 times in the past 15 years, always at a scale calibrated to be significant enough to be unmistakable but not large enough to genuinely destabilize the system it is leveraging. China does not want to destroy the Treasury market. It wants to tax the Treasury market by demonstrating that it can impose costs on it. The tax it is collecting is geopolitical, a modification of American behavior in theaters where Chinese commercial interests are directly affected. Received. That is announcement number 1. Announcement number 2. The $45 billion is the visible component of a much larger structural shift in China's relationship with dollar-denominated assets, and the Middle East escalation is accelerating that shift in ways that will outlast this specific conflict. Stay with me because this is where the story stops being about this week and starts being about the next decade. Since 2022, China has been systematically reducing its treasury holdings from a peak of approximately $1.3 trillion in November 2013 to the current $761 billion represents a reduction of over $500 billion. This reduction has been gradual and managed, designed not to disrupt the market China is exiting, but to reduce exposure over time, while alternative reserve asset frameworks are built. Those alternative frameworks include the expansion of yuan-denominated trade settlement, which according to the People's Bank of China, now accounts for approximately 47% of China's cross-border transactions, up from 15% in 2020, and the development of the mBridge project, a multi-central bank digital currency platform that allows participating nations to settle international transactions without passing through the dollar-based SWIFT system. As of early 2026, mBridge participants include China, the UAE, Thailand, Hong Kong, and a number of nations that have expressed interest in reducing dollar dependence. The Middle East war is accelerating this architecture in 2 ways. First, the disruption of dollar-priced oil flows through the Red Sea corridor is creating practical incentives for oil-producing nations in the Gulf to explore non-dollar settlement for the contracts that are being renegotiated under wartime conditions. Bloomberg reported in March 2026 that Saudi Arabia and the UAE had engaged in preliminary discussions about yuan-denominated supplemental settlement for contracts that cannot use standard dollar mechanisms due to sanctions and logistics disruptions. Those discussions were preliminary. They are accelerating. Second, the perception among non-Western financial actors that the Middle East conflict represents a U.S. strategic overextension is reducing the creditworthiness signal that U.S. Treasury bonds have historically carried. When the safe asset issuer appears strategically overextended, the safety premium on its debt instruments declines. Small declines compound over time. Announcement number 3, and this is the one almost nobody is connecting correctly in the mainstream financial press. The $45 billion freeze is not just about China. It is a signal to every other significant holder of U.S. Treasury securities that China is willing to use its position as a leverage instrument. Saudi Arabia holds approximately $121 billion. Japan holds approximately $1 trillion. If China's use of Treasury holdings as diplomatic leverage proves effective, if Washington modifies its behavior in the Red Sea in response to the economic signal, it will demonstrate to every other large holder that the same tool is available to them. The credibility of the instrument as a coercive tool depends on it being used and being seen to work. This is the moment the financial architecture of American geopolitical power is being tested in a way it has not been tested before. Not because $45 billion threatens the Treasury market directly, but because the demonstration of willingness to use it, if successful, establishes a template. Received. That is announcement number 3. Now, let us talk about what is really happening behind the headlines, because the financial media coverage of this event has been technically competent and strategically shallow. The Wall Street Journal's coverage described the restricted disposition as a signal of displeasure that falls well short of the kind of Treasury sell off that analysts say would be needed to genuinely threaten U.S. borrowing costs. That analysis is technically accurate and strategically incomplete. It focuses on the immediate market impact while missing the institutional signal. Treasury yields moved 11 basis points on the announcement, a movement the journal correctly notes is not catastrophic. But 11 basis points multiplied across the entire U.S. debt load represents approximately $40 billion in additional annual interest costs. And that movement occurred on a signal, not on an action. An action would produce a different number. The sardonic observation worth making here is that American financial commentators spent the better part of 2 decades dismissing the idea that China's Treasury holdings constituted meaningful leverage because, as they correctly noted, China could not dump its treasuries without harming itself. China's not dumping its treasuries? It has found a way to use the option to dump as leverage without exercising it in a way that harms itself. The commentators were right about the constraint. They were wrong about whether China would find a way around it. Think carefully about what this means for the average person watching this analysis. If you own a home with a mortgage, your interest rate is ultimately connected to Treasury yields. If you have a retirement account, it holds instruments whose valuations are sensitive to Treasury market stability. If you buy goods that are shipped, which is almost everything, freight costs are sensitive to the financial conditions of the companies that finance shipping. The $45 billion restricted disposition, through a chain of connections that standard financial media reporting rarely makes explicit, is not an abstraction. It is in your cost of living. This pattern has deep historical roots. Consider the Peloponnesian War. When Athens and Sparta exhausted themselves in 27 years of conflict, the victor was neither the dominant naval power nor the dominant land power. It was Persia, which had funded both sides at strategic moments and positioned itself to dictate the peace. Persia's instrument was not military. It was financial. The Persian satrapy system generated the tax revenues that funded the Spartan navy that ultimately defeated Athens. The weapon was money. The strategy was patience. The outcome was that a conflict between two civilizations produced the dominance of a third that had barely participated in the fighting. China is not Persia. The comparison is not exact, but the logic is recognizable. A third actor, strategically patient, economically powerful, deploying financial instruments at moments of maximum adversarial distraction, positioning itself to be indispensable to the resolution of a conflict it did not start. 3 paths from here. Path 1. Washington modifies its operational posture in the Red Sea corridor sufficiently to address China's stated concerns about commercial shipping disruption. The restricted disposition is lifted quietly. Both sides describe the outcome as routine financial management. The $45 billion instrument has worked. The template is established. Future uses will be calibrated to this precedent. I assess this as the most likely outcome in a 3 to 6 month time frame. Path 2. Washington does not modify its posture, either because domestic political constraints make modification impossible or because the national security establishment refuses to accept that economic coercion has produced a policy change. China escalates the restricted disposition to a larger tranche, perhaps $100 billion or more. Treasury yields move more substantially. The economic costs become visible in ways the financial media cannot understate. A genuine confrontation between U.S. monetary primacy and Chinese monetary coercion becomes the dominant story of 2026 and 2027. This path is possible but requires a miscalculation of political will on Washington's part. Path 3, the one I think matters most in the long run, regardless of which of the first 2 paths the immediate situation follows. The M-Bridge platform, the yuan settlement expansion, and the demonstration of China's willingness to use Treasury holdings as leverage, taken together, produce a structural acceleration in the global movement away from dollar-denominated reserve assets. This is not a sudden collapse of the dollar. It is a gradual, compounding erosion of the safety premium that makes dollar borrowing cheaper than any alternative. Over a decade, that erosion represents trillions of dollars in additional U.S. borrowing costs. Over 2 decades, it represents a fundamental shift in the financial architecture of geopolitical power. The Middle East war did not cause this trajectory, but the $45 billion restricted disposition and everything it signals will be remembered as the moment that trajectory became undeniable. Tell me in the comments whether you think Washington will modify its posture in the Red Sea in response to this financial signal, or whether it will treat the economic pressure as secondary to the strategic objective. Tell me what you think the dollar's reserve status looks like in 10 years if Path 3 unfolds as described. And tell me whether you think the Enbridge platform is as significant as I believe it is, or whether the dollar's dominance is more durable than the evidence suggests. We are tracking every development, from Beijing's financial moves to the Red Sea to the diplomatic corridors in Muscat and Geneva, where the actual shape of what comes next is being negotiated. That is what this analysis does every single day. Subscribe now. Share this with everyone in your network who is trying to understand not just what is happening militarily, but what is happening economically and why it matters for their actual life. Turn on notifications so you do not miss the next update. We will see you in the next one.